Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market so you can better understand what we're seeing and also how we're positioned. You know, earnings season is in full bloom right now. We've had a number of earnings reports from Intel last night as a great example. AMT, Applied Materials last week. We've had a number of retailers that have basically come through. We're getting some banks that are coming through. Generally speaking, most of the earnings are actually, I would say, sour at best, meaning there's a lot more misses than there are actual above expectation gains on earnings. But the real thing is, how do earnings work? Basically what happens is about a month and a half, 2 months ago, as the economy started to slow, analysts mostly from the brokerage houses, which again are Wall Street cheerleaders, which I totally do not even watch, and I would recommend that you don't even listen to their advice because their job is to sell stocks and bonds from brokerage firms. At the end of the day, most of these analysts start ratcheting down their numbers for earnings as things get slower. So now what happens is they ratchet them down enough so some of these companies actually beat and it looks better than it actually is. So at the end of the day, most of the companies that are beating earnings right now are only because Wall Street analysts have reduced their earnings expectations going into this quarter. So companies look like they're either beating or maybe missing by a little bit. But generally speaking, things are getting a little bit weaker. What we really look at earnings season is really what companies are saying. As an example, Intel last night said they're cautious and conservative and nervous, essentially to kind of use words from what I'm hearing. They're nervous in the fact that they're seeing slowdowns, and what we really look at is what their guidance is going forward. Most of these companies that have been giving out earnings reports in the last few weeks are also guiding down quite a bit. In fact, we're seeing the most guidance down and negative outlook that we've seen probably in 3.5 to 4 years. So that tells you basically things are slowing. I have a good friend that manages a Home Depot up in Wisconsin Dells, and I do these spot checks from time to time. I gave her a call and asked her how sales are going. She said, well, in the last 4 to 6 weeks, things have slowed down quite a bit. In fact, in their whole district, they're noticing a marked slowdown across the board. They're doing a lot of credit promotions right now, and that's not even getting the consumer to bite. So what we're essentially seeing is a slowdown. Now, is this slowdown going to lead into a deep, dark recession? As most of you know, last week officially, I called that we are in a recession right now, but the government won't call it for at least 6 to 9 months. I'm going to stick by that. The key is this a mild recession or is this going to be a severe recession? Remember, the average decline in the S&P over the last 10 or 12 recessions have been about 31%. The average decline in the last 2 recessions have been over 50%, the one in 2000 and the one in 2008. So at the end of the day, we are ultra conservative and cautious within all our managed accounts. I would rather give up 3 or 4% of the upside or lag the indexes for 6 months or a year than lose 30 or 40% of our clients' portfolio. We are in protective mode right now. Now, what's interesting is Ben Bernanke came out and spoke yesterday his testimony to Congress, which he does on a regular basis. And again, extremely downbeat. Bernanke basically is nervous. He knows the economy is slowing. He's made that comment to Congress. And he says there's nothing he can really do. Can he do more QE3? Do they have a few more bullets in their chamber, as they call it? Yes. But I think it's going to be ineffective at best. It's like pushing on a string. What he said to Congress point blank, which I love this testimony. In fact, of my 26 years of being in the investment business, this federal chief basically, I think, did one knockout job telling Congress, this is not my problem, it's Congress's problem. You guys need to fix the fiscal problems in this country in order to get this economy back on track. Now, we've all watched Congress in the last couple of years. We've all watched Congress in the last 20, 30, 40 years. I do not think they're going to solve the problem anytime soon, and I think it's going to get worse before it gets better. So we are being very cautious within our client managed accounts. In fact, that served us quite well. I look at quarter to date, we're up about 2.25% almost across the board on our global tactical, while the S&P is basically flat. So being cautious is actually making us money, or making you money ultimately is what we want to do. We are long treasuries. Now, when I talk about where we're at, these may or may not be long positions, and positions can change at any time. While I do not like long-term bonds, we are in long-term treasuries right now simply because they're relatively stronger. They're the fastest horse, as a matter of fact, in the whole stable. So we're long treasuries. We are long publicly traded REITs right now, which is real estate investment trusts. which are doing fabulously well. We're long emerging market bonds, which are doing well. We're long high yield bonds, which are doing well. And we're long corporate bonds, high quality corporate bonds, which again are doing well. These are all very defensive positions. At the end of the day, we want to be more defensive. We can still make money being defensive. We might not make as much, but I'd rather not, again, lose 20, 30, 40, 50% of a client portfolio. Risk management is in place. We're going to run with risk management because right now that is what all of our indicators and our relative strength is telling us to do within client managed accounts. Of course, if you're not a client, I would say you should be a little bit more defensive right now. That would be my personal recommendation. I listen to these Wall Street cheerleaders constantly on CNBC and other news programs. These are the guys that work for Wall Street firms or investment banks and so on. And it amazes me. It's always the time to buy. Never is it the time to sell. Never was it the time to sell in 2000. Never was it the time to sell in 2008. So again, my recommendation is any of these Wall Street firms have conflicted advice and recommendations, and they should be completely disregarded and thrown out the back door. At the end of the day, look at indicators, look at what's going on, and look at the economy. Not to mention the IMF, okay, which basically looks at the world economy, ratcheted down global growth again for this year. So what you're seeing is across the board, not only in this economy that GDP is being ratcheted down and revised down, but also around the world the IMF is also revising growth targets. Historically, and I can tell you this from doing this again a long time, what our government thinks is going to happen and what really happens, as most of you probably realize, is less. So even though the government's looking for maybe not as bad, I think ultimately things could get a little bit worse, especially if this fiscal cliff, which everybody's talking about, and essentially the fiscal cliff is a rise in taxes across the board. And it doesn't matter if you're making $250,000 or you're making $20,000, your taxes are going up at the first of the year because of this fiscal cliff. Now they can push the can down the road and they can do some stuff to kind of push it off for another day or another month or another year, but at the end of the day that only builds up the deficit more. Our country needs hardcore budget constraints and reforms, and also on the tax code. Both of those will ultimately lead to a more stabilization. But I will tell you this, we are, from indicators that we look at, we're still in a deflationary environment. Asset prices still are going down in a lot of pieces of real estate around the country and around the world. Deflation obviously is a negative for equity-based prices. So we look at these things. What was also interesting yesterday is everybody was hoping that Bernanke was going to talk about QE3 or quantitative easing 3, more money printing to basically prop up the economy. He didn't allude to that at all. And what was interesting, even though the stock market rallied just a little bit from his testimony on hopes that he will come, we don't invest on hopes, we invest on facts. And what was interesting is gold actually went down. Gold should actually go up if in fact there is good rumor or good suspicion that quantitative easing, money printing will happen. The more money you print, the more inflationary that tends to be, and gold should technically go up. It actually went down yesterday. In fact, before the market today, it's actually down on the futures. So what we're looking at is, we're looking at an open lower in the market. After this is digested, we're looking at gold down, and we're looking at treasuries again back up to almost new records. I talked about, I believe, the 1 year or the 10-year treasury will be at 1% within 6 months. I'm going to stick to that target unless something changes. But right now I see interest rates actually going down further, which actually will help bond prices on the short term. Remember, these positions are not long-term bets. We're not going to hold these for 20 years unless rates go to zero for 20 years. But realistically, these are going to be shorter term investment strategies in order, A, to capture some possible gain and also to reduce risk in portfolio. If you have questions about your portfolio, if you're concerned about your money, make sure you call our office. If you're a client with any of your questions, we always like talking to you. And of course, if you're not a client or want to become a client, call our office for a consultation. We like taking on new clients who are nice people who want to better their situation. Make sure you listen to tonight's TV show in Southwest Florida, and make sure you listen to my live program this Sunday. It's going to be excellent, and again, have a profitable and safe week.